A defensive stock is not about rapid growth. It is about resilience. While some companies rise and fall dramatically with the economy, defensive companies tend to remain relatively stable regardless of economic conditions. So, they are the exact opposite of cyclical stocks. Understanding that difference is essential. Let's break down what a defensive stock actually is, how it behaves, and how returns are generated. A defensive stock is a share in a company whose revenues and profits remain relatively stable during both economic expansions as well as recessions. These companies provide goods or services that people continuously need, even when economic conditions worsen. Demand for their products does not depend heavily on strong consumer confidence or rapid economic growth. That stability is what makes them defensive. They do not eliminate risk, they reduce sensitivity to economic cycles. So, why do defensive companies remain stable? The key factor is necessity. People may postpone buying a new car during a recession. They may delay vacations. They may cut luxury spending. But they still need electricity. They still need to buy food. They still purchase basic household goods. They still use healthcare services. Because of this, companies in sectors such as consumer staples, utilities, and healthcare often generate steady returns even during economic downturns. The demand curve for these businesses is relatively inelastic. That means that demand does not change dramatically when income of people changes. This economic characteristic explains their stability. Examples of defensive industries are consumer staples, where we include food, beverages, and household products, utilities such as electricity, gas, and water providers, healthcare, where we have pharmaceuticals, medical devices, and so on, as well as basic retail for essential goods. These industries serve recurring, non-discretionary needs. They are not dependent on economic optimism, as no matter what happens, people still eat, still clean, and still brush their teeth, no matter the economic status. Defensive stocks typically generate returns through steady earnings growth, moderate price appreciation, and often dividend payments. Many defensive companies also pay dividends because their cash flows are predictable. Unlike high-growth companies that reinvest aggressively, defensive companies often balance stability with capital returns. However, defensive does not mean high growth. It usually means steady, consistent performance. Let's look at how defensive stocks behave in recessions. Because during economic downturns, defensive stocks often outperform the broader market. But this does not mean that they rise dramatically. It often means that they fall less. If the overall market declines sharply, defensive stocks may decline more moderately. That relative stability becomes valuable during periods of uncertainty. In strong bull markets, defensive stocks may underperform high growth or cyclical sectors. So, stability comes at the cost of explosive upside. If you recall from the previous video, cyclical stocks depend heavily on economic expansion. Here we learned that defensive stocks depend on consistent demand. And so, when the economy accelerates, cyclical stocks often outperform. When the economy contracts, defensive stocks often outperform. Neither is superior in all environments. They simply respond differently to economic forces. Understanding this exact distinction helps investors align expectations with reality. Defensive stocks are not risk-free though. They can still decline in market crashes. They can become overvalued if investors crowd into the so-called safe assets. In fact, as at the time of recording this video, the consumer staples sector is at the same valuation as the technology sector. Furthermore, rising interest rates can pressure defensive stocks, especially those with high dividend yields. Slow growth can also limit long-term upside. Defensive investing reduces volatility. It does not eliminate uncertainty. Defensive stocks are about stability, not speed. They are designed to endure economic stress, not to dominate economic booms. They reward patience and discipline, but they still require analysis and valuation awareness. These stocks are not exciting, they are resilient. And that is what a defensive stock is.